Picture this. You're scrolling through your trading app at 9:30 a.m., coffee in hand, and suddenly AVCT catches your eye up 15% in pre-market trading. Your heart races. Is this the comeback story of the year? A hidden gem finally breaking out? Or are you staring at one of the market's most dangerous mirages? Today, we're diving deep into the AVCT mystery, a tale of two companies, one tragic liquidation, one living biotech dream, and the critical lessons every investor needs to know. Buckle up, because by the end of this investigation, you'll never look at a ticker symbol the same way again. Chapter 1. The Rise and Spectacular Fall of American Virtual Cloud Technologies. The Golden Days. 2 minutes. Let's rewind to 2020. American Virtual Cloud Technologies, ticker AVCT, was riding the cloud communications wave. Founded way back in 1987 in Atlanta, Georgia. This wasn't some fly-by-night startup. They had decades of experience, strategic partnerships with tech giants like AT&T and IBM, and a product suite that seemed perfectly positioned for the work-from-home revolution. Their flagship product, the Candy platform, promised to revolutionize business communications. Unified communications as a service, contact center solutions, Microsoft Teams integration, everything enterprises needed as they scrambled to adapt to remote work. The stock soared to an eye-watering peak of $168.75. Yes, you heard that right. Nearly $170 per share. Investors were intoxicated by the cloud communications gold rush. Revenue was flowing, partnerships were expanding, and AVCT seemed destined to join the ranks of the great cloud success stories. But as we'll see, appearances can be devastatingly deceiving. The warning signs nobody saw. 3 minutes. Here's where the story takes a dark turn, and it's a masterclass in why financial statements matter more than hype. While AVCT's stock price was painting a picture of success, the underlying business was hemorrhaging cash at an alarming rate. Let's break down the numbers that should have sent investors running for the exits. In 2022, when the company still looked legitimate on paper, they posted revenue of just $16.81 million. For a company valued in the hundreds of millions, that's already concerning. But it gets worse. The gross profit margin? Negative 9.29%. Think about that for a moment. For every dollar of product they sold, they lost more than 9 cents just in the cost of producing it. This isn't a pricing problem or a temporary squeeze. This is a business model that fundamentally doesn't work. The operating margin? A catastrophic negative 318.73%. They were burning through $3.19 in operating expenses for every dollar of revenue. The net loss in 2022 alone was $213.62 million, more than 10 times their entire revenue. Meanwhile, revenue was actually declining, from $20.05 million in 2021 to $16.81 million in 2022, a 16% drop while expenses continued to skyrocket. By the first quarter of 2023, quarterly revenue had collapsed to just $4.06 million, putting them on pace for less than $17 million annually. The stock price told the real story that smart money was already fleeing. From that $168 peak in 2020, shares crashed to $36.45 by 2021, a brutal 78% decline. By 2022, the stock was trading at just $1.15, representing a 99.3% destruction of shareholder value from its peak. The final chapter, 2 minutes, January 11th, 2023. The inevitable finally happened. American Virtual Cloud Technologies, along with its subsidiaries, filed voluntary petitions for Chapter 11 bankruptcy protection in the Delaware Bankruptcy Court. The filing cited the company's inability to meet its financial obligations and the urgent need for a comprehensive restructuring. But this wasn't going to be one of those feel-good turnaround stories. By March 2023, it became clear that liquidation was the only viable option. The company held an auction of its assets, raising approximately $6.8 million, a fraction of what investors had poured into the company over the years. On May 23, 2023, the bankruptcy court confirmed the Chapter 11 plan of liquidation. 7 days later, on May 30th, the plan became effective. And here's the crucial detail that every investor needs to understand. All existing common stock and warrants were canceled without any compensation to shareholders. Zero. Nothing. Complete and total loss. The Options Clearing Corporation issued adjustment notices, confirming that all AVCT options contracts would be settled for a cash payment of just $3.07 per contract, essentially worthless. FINRA issued delisting notifications, and the ticker symbols AVCT and AVCTQ were officially terminated. Chapter 2. The Phantom Trading Phenomenon. Why dead stocks still show prices. 2 minutes. Now, here's where things get really interesting and dangerous for unwary investors. Even though American Virtual Cloud Technologies was completely liquidated with equity canceled, some trading platforms and financial data aggregators still display prices for AVCTQ. You might see quotes around 18 cents, or even witness sudden jumps that create the illusion of trading activity. But this is like watching the last electrical impulses in a brain after clinical death. It looks like life, but it's just residual neural activity. Several factors create this phantom trading phenomenon. First, over-the-counter markets sometimes maintain shell listings for defunct companies, allowing for extremely thin speculative trading among uninformed retail investors. Second, algorithmic data feeds don't always update in real time when companies are liquidated, leading to stale price discovery mechanisms. Third, and most perniciously, prediction websites and model-driven investment platforms continue generating price targets and analysis for AVCTQ as if it were still an operating company. These automated systems don't understand bankruptcy law. They just crunch historical data and spit out forecasts that are completely meaningless for a liquidated entity. The mirage of recovery, 1.5 minutes. Some investors seeing these phantom price movements convince themselves that maybe, just maybe, there's still hope. Maybe the company will emerge from bankruptcy. Maybe shareholders will get something. Maybe those 18-cent quotes represent real value. Let me be absolutely clear. This is a dangerous delusion. Under the confirmed Chapter 11 plan of liquidation, equity holders are explicitly excluded from any recovery. The legal documents are unambiguous. Shareholders receive nothing, and there is no mechanism for future distribution. Any money spent buying AVCTQ shares today is money thrown into a legal void. It's not investing, it's gambling on something that has already been definitively resolved by federal bankruptcy court. Chapter 3. The Living AVCT. Avacta Group's Biotech Journey. Meet the real AVCT, 2 minutes. Now, let's shift gears completely and travel across the Atlantic to London's AIM market, where an entirely different company trades under the ticker AVCT. Meet Avacta Group plc, a legitimate, operating life sciences company that couldn't be more different from its defunct American namesake. Founded and headquartered in the UK, Avacta Group is a clinical-stage biopharmaceutical company focused on developing innovative cancer therapeutics and diagnostics. Their core technology platform, called Precision, represents a novel approach to targeted cancer therapy using what they call affimer proteins, engineered alternatives to antibodies that can potentially deliver drugs more precisely to tumor sites. Unlike the cloud communications company that burned cash on a broken business model, Avacta is methodically advancing through clinical trials with multiple drug candidates in their pipeline. They're targeting some of the most challenging cancers, including solid tumors that have historically been difficult to treat with conventional therapies. Recent corporate developments, 2 minutes. In July 2025, Avacta Group made headlines with a significant corporate finance move that demonstrates the stark difference between a living company and a liquidated shell. The company successfully completed a £3.25 million equity placing at 30 pence per share. This wasn't a desperation move, it was strategic financial planning. The proceeds were specifically earmarked to settle a convertible bond repayment that was due in July 2025, effectively cleaning up the balance sheet and providing additional working capital flexibility as the company advances its clinical programs. Following the admission of these new shares, Avacta's issued share capital increased to approximately 404.5 million ordinary shares. The company's management emphasized that this financing positions them for what they described as a pivotal commercial period with multiple catalysts ahead. These are the actions of a company with a real business, real products in development, and real strategic planning. The contrast with American Virtual Cloud Technologies couldn't be more stark. The science behind the investment, 2 minutes. The science behind the investment, 2 minutes. What makes Avacta genuinely intriguing from an investment perspective is their differentiated approach to cancer therapy. Traditional cancer drugs often struggle with what's called the therapeutic window, the narrow range between an effective dose and a toxic dose. Avacta's pre-Cesian platform aims to solve this by using Affimer proteins to create prodrugs, essentially inactive drugs that only become active when they encounter specific conditions in the tumor environment. This could theoretically allow for higher doses of potent cancer drugs while minimizing systemic toxicity. Their lead program, AVA6000, is designed to target fibroblast growth factor receptor 3, which is overexpressed in certain bladder and other cancers. Early clinical data has shown encouraging signs of both safety and efficacy, though as with all early-stage biotech investments, the ultimate commercial success remains highly uncertain. The company is also developing diagnostic applications of their Affimer technology, potentially creating multiple revenue streams from their core platform. This diversification could provide more near-term commercial opportunities, while the therapeutic programs advance through longer development timelines. Chapter 4. Decoding the price movements. Why Avacta's stock moves. 2 minutes. When you see AVCT jumping on London markets, you're witnessing the real forces that drive biotech stock prices. Unlike the phantom movements of the liquidated American company, Avacta's price action reflects genuine market forces responding to real business developments. The July 2025 equity placing initially created some downward pressure as the market absorbed the dilution from new shares issued at 30 pence. However, as investors digested the strategic rationale, debt reduction and enhanced financial flexibility sentiment began to improve. Technical factors also played a role. When Avacta's shares crossed above their 200-day moving average, algorithmic trading systems and momentum-following investors began accumulating positions. This created a feedback loop that amplified the upward movement. But the most significant drivers are event-driven. Biotech stocks live and die by clinical trial results, regulatory approvals, partnership announcements, and intellectual property developments. Every press release, every conference presentation, every regulatory filing can move the needle significantly. The Biotech Volatility Playbook, 1.5 minutes. Understanding biotech price movements requires thinking like a scientist and trading like a poker player. The fundamental value proposition is binary. Either the drugs work and create massive value, or they don't, and the investment goes to zero. There's rarely middle ground. This creates enormous volatility around key inflection points. A positive phase 2 trial result can double a stock overnight. A regulatory setback can cut it in half just as quickly. Smart biotech investors size their positions accordingly, understanding that they're essentially buying lottery tickets, but lottery tickets backed by rigorous science and experienced management teams. For Avacta specifically, key catalysts to watch include clinical trial readouts, potential partnership deals with larger pharmaceutical companies, regulatory milestone achievements, and intellectual property developments. Each of these events can create significant trading opportunities for investors who understand the science and time their entries and exits appropriately. Chapter 5. The Complete Investor's Playbook. Step-by-step due diligence framework. 3 minutes. All right, let's get practical. Whether you're investigating AVCT, AVCTQ, or any other confusing ticker situation, here's your complete due diligence framework to avoid costly mistakes and identify genuine opportunities. Step 1. Verify the company identity. Never assume ticker symbols tell the whole story. Check the exchange, the company name, the headquarters location, and the industry sector. Use multiple sources: Yahoo Finance, SEC filings, company websites, and exchange listings. If you see prices in dollars, you might be looking at a US company. If you see prices in pence, you're probably looking at a UK company. Step 2. Confirm operational status. Search for recent SEC filings, press releases, and regulatory announcements. Look for terms like bankruptcy, liquidation. Chapter 11. Or going concern qualifications. For the American AVCT, SEC filing 8K from May 30th, 2023, explicitly confirms the effective date of the liquidation plan and cancellation of equity interests. Step 3. Analyze financial health. For operating companies, dig into the latest financial statements. Look for sustainable revenue growth, positive or improving margins, manageable debt levels, and adequate cash runway. Red flags include declining revenues, negative gross margins, and burn rates that exceed cash reserves. Step 4. Understand the business model. Can you explain in simple terms how the company makes money? Is it a scalable, defensible business model? For biotech companies like Avacta, understand the pipeline, the competitive landscape, and the regulatory pathway to commercialization. Step 5. Assess risk. Reward ratios. Every investment should have a clear thesis for potential returns and a realistic assessment of downside risks. For liquidated companies like American Virtual Cloud, the downside is 100%, and the upside is 0. For clinical stage biotech like Avacta, the downside is still potentially 100%, but the upside could be multiples if the science works. Step 6. Size positions appropriately. Never bet more than you can afford to lose on speculative investments. A good rule of thumb for biotech investing is to limit individual positions to no more than 5% of your total portfolio, with the understanding that some percentage of these investments will go to zero. Tax strategy and portfolio management, 1.5 minutes. For investors who got caught in the American Virtual Cloud liquidation, there are still strategic moves to make. The complete loss of equity provides opportunities for tax loss harvesting. Depending on your jurisdiction, you can typically claim the full amount of your investment as a capital loss, which can offset capital gains from other investments or provide deductions against ordinary income up to certain limits. The key is proper documentation. Keep records of your original purchase dates, purchase prices, and the official liquidation effective date of May 30th, 2023. This creates a clear tax event that most tax professionals can work with. Looking forward, use this experience to improve your investment process. Develop better screening criteria for financial health. Set stop-loss levels to limit downside exposure. Diversify across multiple investments rather than concentrating in individual stocks. And always, always, read the financial statements before investing. Chapter 6. Broader market lessons and future outlook. The ticker symbol trap, 2 minutes. The AVCT confusion illustrates a broader problem in modern markets. The proliferation of similar ticker symbols across different exchanges and the persistence of data for defunct companies creates dangerous investment traps. This problem is getting worse, not better. As global markets become more interconnected and retail investing platforms make it easier to trade international stocks, investors increasingly encounter situations where the same letters represent completely different companies in different countries. Major financial data providers like Bloomberg and Reuters have sophisticated systems to handle these distinctions, but retail-focused platforms often lack the same precision. Social media compounds the problem, with investors discussing AVCT without specifying which company or exchange they're referencing. The solution is investor education and better due diligence habits. Never make investment decisions based solely on ticker symbols or social media discussions. Always verify the underlying company, its operational status, and its financial health before committing capital. Industry trends and future opportunities. 2 minutes. Looking ahead, both the cloud communication sector and the biotech sector offer genuine investment opportunities, but only for investors who can distinguish between viable companies and failing ones. In cloud communications, the underlying market trends remain strong. Remote work is here to stay. Businesses continue migrating to cloud-based solutions, and artificial intelligence is creating new demand for sophisticated communication platforms. But success requires companies with sustainable business models, positive unit economics, and the ability to compete against well-funded giants like Microsoft and Cisco. In biotechnology, we're entering what many consider a golden age of drug development. Advances in artificial intelligence, genomics, and personalized medicine are creating unprecedented opportunities to develop effective treatments for previously intractable diseases. Companies like Avacta, with differentiated technology platforms and experienced management teams, could potentially deliver significant returns, but only if their science proves successful in clinical trials. The key for investors is learning to evaluate these opportunities based on fundamentals rather than hype, understanding the risk-reward profiles, and sizing positions appropriately for the level of speculation involved. Closing. Your investment action plan. AVCT. Any positions in AVCTQ or American Virtual Cloud Technologies, recognize that this is a complete loss and consider tax loss harvesting strategies. There is no recovery scenario for equity holders. Second, if you're intrigued by Avacta Group or other legitimate biotech opportunities, approach them with the appropriate level of caution and diversification. These are inherently speculative investments that require deep research and careful position sizing. Third, use this entire episode as a learning opportunity. Develop better due diligence habits, verify company identities before investing, and always read the financial statements. The market is full of both opportunities, and traps your ability to distinguish between them will determine your long-term success. Remember, in investing as in life, things are rarely as simple as they first appear. The letters AVCT can represent either a cautionary tale of spectacular failure or a potential growth story in cutting-edge biotechnology. Your job as an investor is to know the difference, understand the risks, and make informed decisions based on facts rather than hope. The market rewards preparation, punishes assumptions, and never stops teaching those willing to learn. Make sure you're always in the latter category.